to the Mortgage Rate Weekly Market Update for the week of June 5th, 2017. Hello, I'm John Thomas with Primary Residential Mortgage, here to give you your update. Well, last week was great for mortgage rates. Mortgage rates moved to the lows not seen since last year, so best rates of 2017. Take a look at the bond chart on the screen. You can see the big long-term picture there. Mortgage bonds, you can see, have gotten all the way up to this big ceiling of resistance that's been a ceiling for a long time. We haven't even hit this for a long time. But the good news is we broke above the 200-day moving average. We closed just above that. We haven't been above that since back in 2016. That's great news. The treasuries have broken below a level of support as well, so that's good news there. So we're at a wait-and-see stance right where we're at. Mortgage bonds can, if they can maintain above the 200-day moving average, we could mount a rally higher in the bond market, which means we could see rates move even lower. But if they close below the 200-day moving average, the pattern has been they would sell off and rates would move higher. So if you're okay with your rate, go ahead and lock it in and just run with it. Now, we are recommending you could cautiously float your interest rate to start the week, but you'd have to monitor the bond market. If it were to close below that 200-day moving average, you would quickly want to lock as fast as possible because rates would definitely move higher from there. So we're going to keep an eye out on that. But you could lock if you're happy with your rate. No one's going to hate you taking the best rates all year. But if you want to gamble, you can go ahead and cautiously float your mortgage interest rate to see if we can close above the 200-day moving average and see if bonds can mount a rally from here. Now, in economic news, the big thing that helped the rates rally last Friday was the U.S. Labor Department released the jobs report for May 2017, and it was the stinker. Man, they were expecting 180,000 jobs created. We only had 138,000 jobs created for May. And they revised March and April's jobs reports lower by 66,000 jobs. Now, on a positive note, the unemployment rate did tick down again from 4.4 to 4.3%, which is a 16-year low, the lowest it's been since the recession. Now, the total unemployment measure, which is called the U6 number, that fell from 8.6% to 8.4%, which is down from 9.4% of May of last year. And I remember the U6 measures total unemployment. That's people that are, part-time that would like to be full-time, that kind of stuff. And then we saw the labor force participation rate, the LFPR, decline from 62.7 to 62.9%. The labor force participation rate measures the number of people 16 years and older that are eligible to work or actually working. So that was, the unemployment rates were coming down, but the number of jobs created is just very bad. So the bond market rallied on that. Then we saw a measure of inflation, which was the core personal consumption expenditure, or PCE, for April 2017. That's the Fed's favorite measure of inflation. It was up 0.2% from March, but it was down to 1.5% year over year from 1.6% last April. So inflation is actually now trending down. It was trending up, which was not bond friendly. So we had two real good reports that helped us get the bond market to move interest rates lower. That was the stinker of the jobs report, and inflation's coming in pretty tame here. So part of the reason for the decline is we're comparing year-over-year inflation to, part of that is a big influence is oil prices. So oil prices last year were higher than they were now because we had a rally in the oil market last year. Oil prices are coming down now. A couple reasons for that. People aren't real sure OPEC, all the OPEC members are going to stick to the production cuts they agreed to. And the United States, oil production is up. So as we flood the market as well, and they don't cut when they're supposed to cut, supply and demand is going to drive the price of oil down. Then we saw weekly initial jobless claims come out on Thursday. They were up 13,000 to 248,000 claims. That was about 10,000 more than expected, but still a decent number for first-time claims. Weekly initial jobless claims from below 300,000 for some time, so that still shows a very stable labor market. Now, in the housing news, we saw pending home sales for April 2014 fell 1.3% from March, and they're now down 3.3% from a year ago. So that might seem like it's bad news for housing, but it's not, because the foot traffic is higher than it was a year ago, so demand for purchasing a home is there. The lack of inventory is what's keeping the pending home sales down. So inventory is down 9% from last year. So that's why foot traffic is not translating into home sales. But the pent-up demand is there, so if home values can come up and more homes can come on the market, we will see these home sales translate into actual sales. So pending home sales is a future indicator of existing home sales. So that'll keep an eye out for that. So that means existing home sales should theoretically drop because pending home sales have dropped. Now, then we saw the Case-Shiller 20-City Home Price Index from March 2017. It rose 5.9% year over year. The price appreciation gains in March matched the gains in February, which is the biggest gain since July 2014. Home prices increased on average 0.9% from February to March on the 20-City Index. The low supply of homes for sale is the case for the rising home prices. If we look at the local market in Delaware, it's predicted to have a 3.6% rise in home price over the next year. And historical price appreciation of the last 5 years in Delaware is 9.68%. So what does that mean? Real estate is still a great investment long term. Definitely a way to go if you're looking to build long-term wealth, because you will get the price appreciation over time. I think when I ran the numbers since 1991, and just in Delaware alone, the price appreciation is 92 point some percent. I mean, that's insane. So real estate is a great way to invest in your future. Now, we also we answered some questions here. We had one of the big questions we've been getting lately is help in understanding the seller paid closing costs. So we did a blog post on that. In the blog, there's a link for that, understanding seller paid closing costs. If you want to know how much you can get, when you get it, all that kind of stuff, all your questions are answered. And then in the local news, the next first-time homebuyer seminar is Saturday, June 17th in Newark, Delaware from 10 a.m. to noon. And then that's at the Christiana Hilton Hotel. And then the next one in Dover is Saturday, June 24th from 10 a.m. to noon at the Dover Holiday Inn. You can register for either one of those events by giving us a call in the office at 302-703-0727, or you can register online, www.delawarehomebuyerseminar.com. Again, if you're looking to get pre-approved for a mortgage to purchase or refinance and take advantage of these great low rates, feel free to give us a call, 302-703-0727, or you can apply online, prmiloanapplication.com. Look forward to seeing you guys next week.